All right, welcome. If you're gearing up for your GCSE Economics exam, then you have come to the right place. In this explainer, we are going to dig into everything you absolutely need to know about topic 3.3, the fair distribution of income. We'll cover everything from the core definitions to the key evaluation points that'll help you smash your exam. So let's jump right in. So, what's with this number? 969 years. Believe it or not, that's how long an average UK worker would have had to work back in 2017 to make what golfer Rory McIlroy earned in that single year. I mean, that's just a wild number, right? And it really sets the stage perfectly for what we're about to talk about, the massive scale of income inequality. Okay, so before we can really dig into inequality, we've got to get crystal clear on two key ideas: income and wealth. Now, they sound similar, but trust me, for an economist, and definitely for your exam, knowing the difference is a really big deal. Right, and this slide shows the key difference beautifully. I want you to think of income as a flow. Imagine a river that's constantly moving over time. That's your income. Wealth? That's a stock. Picture a lake. It's a snapshot of everything you own at one single point in time. Let's break that down a bit more. Okay, so income is that flow of money coming in. For most of us, the biggest chunk of that comes from wages or a salary from work. But it could also be things like rent you get from a property, interest on your savings, or even dividends from shares. It's that continuous stream of cash. Now, wealth, that's the total value of everything you own. This includes the cash in your savings account, what your house is worth, the value of your shares, and even things like your car or jewelry. So it's not about what you earn week to week, it's about what you have in total right at this moment. All right, so we've got our definitions down. Income is the flow, wealth is the stock. Got it. But what does that actually look like in the real world? Let's dive into some data and see how income is really spread out across the UK. Now, this is where it gets really interesting. This chart gives us a crystal clear picture of that distribution. So if we slice up the UK population into 5 equal chunks, you can see that the top fifth, the highest earners, took home a massive 40% of all the income in 2017. Now look down at the bottom fifth. They got just 8%. That's 5 times more income for the top group compared to the bottom group. A huge difference. Looking at that chart, it just begs the question, right? And it's a question you absolutely need to be ready for in the exam. Why? What are the economic reasons that income is spread so unevenly?
Well, there are a few key things going on here. First up, you've got skills and education. Think about it. A highly skilled surgeon is going to be in much higher demand than someone with fewer skills, so they can charge a lot more for their work. Simple supply and demand. Second, and this is a big one, owning wealth actually creates more income. If you own property, you can get rent. If you have shares, you get dividends. It's like a whole other income stream that people without those assets just don't have access to. And of course, we can't forget things like age and experience and persistent problems like the gender wage gap. They all feed into the inequality we see in the data.
Okay, so we know what it is and what causes it. But here's the million-dollar question. Is it actually a bad thing for the economy? This is where you get into the real meaty analysis. It's a debate with two really clear sides, and for those top marks, you've got to be able to argue both of them. Let's start with the argument against inequality. The idea goes like this. A massive gap in income means the poorest households don't have much money left over after essentials. And here's a key bit of economics for you. Lower income families tend to have what's called a higher marginal propensity to consume, which is just a fancy way of saying they spend a bigger slice of any extra cash they get. So if all the money is stuck at the top with people who tend to save more, then overall spending in the economy, the aggregate demand goes down, and that can put the brakes on economic growth. But of course, there's another side to this story. This argument says that, actually, income differences are a good thing. They act as a massive incentive. Why? Because the chance to earn more money pushes people to get educated, to train, to develop new skills. And what does that do? It creates a more productive workforce for the whole country, which boosts the economy's potential and drives growth in the long run. So you've got this big debate with good points on both sides. It's no surprise that governments often step in. And their main tool is fiscal policy, taxes and spending. They use it to try and tweak the level of inequality and get to what they see as a fairer outcome. The number one tool they use for this is what's called a progressive tax system. The logic behind it is pretty straightforward. The more you earn, the higher the percentage of your income you pay in tax. The whole point is to shrink that gap between the richest and the poorest. Okay, let's look at an example to see exactly how this works.
Meet Ben, who earns £25,000 a year, and Amy, who earns £52,000. So, under a progressive system, Ben ends up paying £3,000 in tax, which works out to be 12% of what he earned. Amy, because she earns more, pays a lot more, £8,900. And look, that's about 17% of her total income. The key thing here is that she's not just paying more in pounds and pence, she's paying a higher share of her income. That right there is progressive tax in action. And this brings us to the absolute core evaluation point you need for your exam. It's all about a trade-off. So on the one hand, all that tax money can be used to fund things like benefits and public services, think schools and hospitals. That helps reduce poverty and gives people a safety net. But on the other hand, there's a worry. Some economists argue that if taxes get too high, it might discourage people from working harder or taking risks in investing. And if that happens, it could actually hurt the very economic growth we were just talking about. Okay, this brings us to our last point, and honestly, it's one of the most important distinctions you can make to really impress an examiner. We need to be super clear on the difference between fairness and equality.
So let's ask the obvious question. When a government tries to redistribute income, is the goal to make everyone earn the exact same amount of money? Well, the short answer is no, not at all. And here's the crucial reason why. The word equality is what we call a positive concept. It's a statement of fact that you can measure. Does everyone have the same income? Yes or no? But fairness, sometimes called equity, that's a normative concept. It's all about a value judgment, an opinion on what is right or just. For example, most people would probably agree it's fair for a brain surgeon to earn more than a medical student, right? Even though it's not equal. And that really gets to the heart of this entire topic. The aim for most governments isn't to create perfect equality. It's about trying to find this incredibly tricky balance. How do you reward hard work, skill, and effort, the stuff that fuels the economy, while at the same time making sure that everyone has a fair shot at success? Honestly, there's no simple answer, and it's one of the biggest challenges economists and politicians are still wrestling with every single day.